Good morning.
Morning.
So yesterday we did introduce on how to do appraisal or investment appraisal. Okay, and see that we can use two methods. Well, we can the main method we can use are two. We have the discounted and you have the non-discounted cash flow techniques. We did the non-discount cash flow techniques, both of them. The use of the payback period method and the use of return on capital employed. Okay, which we did those two. So today I want us we start off by discussing the discounted cash flow techniques, okay? And before we begin, okay, the best thing, of course, definitely is to determine how do we discount, okay? How do we discount cash flows? How do we get for the current value of cash flow in to be received in the future, okay? Then we can discuss what is NPV, what is IRR, and what is the discounted payback period by first knowing how to discount, okay? So we begin there by discussing how we discount, okay? And what's discounting? Okay, so discount is simply determining the current value of some future sum of money. Okay, that remember discounting. Okay, so very simple explanation called time value of money. Time value of money. Okay, time value of money, and can begin by with first concept is compounding. Then discuss on discounting. Now compounding is getting the future value of sum of money. Okay, so discounting. Okay, it is a determination. Compounding is a determination of the future value. Okay, of the future value of a sum of money. Of a sum of money. Okay, determination of the future value of a sum of money is referred to as compounding. Okay, you want to get value in 3 years time, in 4 years time. Okay, that will determine referred as compounding. For example, okay, okay, if Mr. A invests in a bank, okay, invest in or deposit money in a bank, so makes a deposit in a bank that yields 10% per annum, that yields 10%, okay, per annum, makes $1,000 deposit in a bank that yields 10% per annum. Okay, what would be the deposit value? Okay, 3 years from now, 3 years from today. Okay, so you want to determine what will be the value of this deposit, okay, 3 years from now, okay? If the deposit was made today at 1,000 and is earning 10% per annum, okay? A very simple one for sure, okay? It will be equal to, okay, the interest earned in year one, okay, will be equal to 1,000, okay, times 10%. Therefore, the year one, you earn an interest of $100. The interest earned in year two, there's no withdrawal of money. So the interest is also reinvested in the bank. Therefore, by the end of year one, beginning of year two, the total investment value is 1,100 times 10%. Okay, to give therefore 110. In year three, okay, beginning of year three, end of year two, the total amount the company has invested is therefore equal to 1,100 plus the interest earned, which is equal to 1 to 10, okay, times 10%, to give therefore 121. Therefore, by the end of those 3 years, the total investment, the total interest earned, is therefore equal to 331. Therefore, the total value, the deposit value, okay, deposit value, okay, in T3, end of year 3, it will be equal to 1,000 initial deposit plus interest earned 331 to give therefore 13,331. Okay. For the 20 years, that will be a lot of work, okay, because it will be a lot of work for you. So the best thing, okay, or is the future value is given us the current amount you have invested, and we call it present value. Okay, future value. That is the value at the end of year 3, and so can be given us the present value, okay, 1 plus r to the power of n, okay, where fv is future value, Okay, PV is equal to present value. Okay, R is the compounding rate per period, compounding rate per period. Okay, and N is the number of compounding period, number of periods. Okay, most of the time the periods will be years. Okay, but not always the case. Okay, so most of the time the N will be years. Okay, but not always the case. They have a future value as at year 3, the present value 1,000. It earned 1.1 10% per annum, the power of 3, and therefore the value will be equal to 13,331. Clear? That's compounding a simple cash flow or compounding a lump sum. Any question? Alvin, it's all clear?
Yes, it's clear.
Okay. Now, what if you have a case where, okay, let me call this example 2. What if you have a case where the deposit that this person is making is a constant? That is, the deposit is made 1,000 every year, okay? Don't forget, in this example we just done here, the deposit was only once today, okay? We only make one single investment, one single deposit. But however, what if you have a case where they have the deposit being made every period, okay? Okay. Assume this is a continuation. Assume the 1,000 deposit, okay, is made every year for 3 years, is made every year beginning for 3 years. What is the deposit value out of T3? End of T3. T3 means year 3, okay, or the deposit value end of T3, okay. So you have the deposits to made every year, okay, for the next 3 years, okay. Then the interest to be earned, okay, then the interest that to be earned will be equal to, for year 1, the interest that to be earned will be 10% of the deposit for year 1, which is 1,000, to give us 100, okay. For year 2, we have the total value of the investment, okay, is equal to 2,000, because you have 1,000 for year 1, 1,000 for year 2, then plus the interest earned, 2,100 times 10% to give us 210. I hope that's clear. Every year you invest 1,000. Every year you invest 1,000. Therefore, at the beginning of year 2, we have 1,000 for year 1 and 1,000 for year 2 plus the interest earned in year 1, which was 100. In year 3, the total investment value you have is therefore 3,000 plus total interest earned. Okay, therefore we go to 3,000 and 310. Yes, times 10%. You therefore 331. Yes, total interest earned is therefore equal to, okay, 641. Therefore, value of the deposit, okay, value of the deposit, okay, T3, head of your T3 at T3.
Excuse me, sir.
Mm,
Isn't in year 3? Isn't it supposed to be 3,210?
don't forget 210. Okay, yeah. No, don't forget. Here, year 3, as at the beginning of year 2, we have 2,100, isn't it?
Yes.
Plus 210, what do you get?
Oh, okay.
Plus 1,000, okay? Then we get the 310, okay?
Thank you.
If we get therefore to be 3,000, the total deposit made plus 641, the interest earned, to get therefore that 641, okay? Yeah, therefore the value of the deposit at the end of year 3 with that 641. What if you have 20 years? You can't do all this process, it's a lot of work, okay? Therefore, what do you do? Or the future value, okay? Don't forget, this 1,000 is an equal amount that is the company is investing, okay? An equal amount the company is investing every year. Therefore, this 1,000 is what if we define to as an annuity, okay? It's called an annuity. Therefore, to be equal to the annuity, okay? 1 plus r, okay, to the power of n, okay, minus 1, we divide by r, okay? Okay, that is in case we are discounting an annuity. An annuity is an equal amount that is invested or received over an equal time period. this 1,000, okay, it's being invested every year, okay, therefore qualifies to be an annuity. It's not a single cash flow, it's an annuity as per se. Therefore, if we use the formula, it will be equal to 1,000, okay, interest earned is 10%, 1.1 to the power of 3, okay, minus 1 divided by 0.1, and you get how much?
$33.10.
330?
33.10.
That's 310. Okay, that's 310. Okay. Now, the thing is that these cash flows are being invested at the beginning of the year. Since they have been invested at the beginning of the year, where is that? Yes, beginning of the year. They need to qualify our formula here. That, hey, this is formula for what we call cash flow occurring end of the period. Okay, cash flow occurring end of the period. But since the beginning of the year, they need to qualify this by 1 plus R. 1 plus R, okay? Because they're occurring at the beginning of the year. So any cash occurring at the beginning of the year, we ought to qualify that, okay? Therefore, times 1.1. So you get how much?
$36.41.
1. 641.
36.41.
Okay, yeah, that's 641. Okay, so if in the case we have cash flows occurring, or if they are annuities, okay, then of course it's best to use the formula. Okay, if you are compounding, okay, if you are compounding, it's much better to use the formula. Okay, now let's assume, okay, and by the be careful the terms that are normally used in the question are the cash flow occurring end of the year or beginning of the year. Okay, but for examine, actually, most of the time, the examiner tells you that occurs at the end of the year. Okay, but either way, it's good you check on the question. Maybe you never know. You don't want to make a mistake. Okay, with the cash flow, if they're occurring beginning of the year, then of course the future value is very different. Okay, because as you can see, if they're occurring end of the year, we got the 310. But if they're occurring beginning of the year, we got the 641. Let's try another example. If the investment is a continuation, if the 1,000 deposits, if the 1,000 deposits, okay, are made every 6 months, every add of 6 months, okay, what would be for 3 years? For 3 years. For 3 years. Okay, what is the deposit value? The deposits value end of year 3. End of year 3. Can you do that? Okay, let me see how far you can go. So this deposit occurring end of the period, not beginning, but end of the period. What do you get with the future value end of year 3? Nafisa, what do you have?
$7,716.
So Nafisa, 7,000.
716.
716, okay. Sakina, what do you have?
6802.
6802. Brian, what do you have?
84.87.
487. Sanya, what do you have?
$7,716.
Okay, Elvin.
$6,620.
620.
Yeah.
Okay, Daisy, what do you have?
$7,716. Sorry, I had not unmuted my.
Okay, let's attempt. Okay, seeing that you have some diverse answers. Okay, so here you're making the investment end of the period. Okay, and you will determine what to be there for the value of the investment by the end of year 3. So first determine how many periods we have. Okay, n is equal to, there are 3 years, but you're making a deposit every 6 months, therefore times 2. Therefore, you have 6 periods. The rate of return, okay, it was 10% per annum, but now for 6 months, it'll be 6 out of 12. Give therefore half, which is 5%. Okay, and that is it. The future value, therefore, be equal to the annuity, 1,000, occurring end of the period, times 1.05, the power of 6, minus 1, divided by 0.05. And we get how much?
$68.02.
802. Okay, and it gets 602. Okay, I think some of you got that answer, 6802. The one who got 7,000, okay, 7,700 something. What did you do?
I forgot to divide it by 12
Okay, you forgot to write
for the
it.
rest.
Okay, yeah, for the rate, you have to consider that the rate 10% was per annum. Therefore, for 6 months, it was 5%. The one who got 8,000, that was Brian, I guess.
Yes.
What did you do?
I used the formula and okay, I didn't divide by 6/12 first, and then I also multiplied after getting this. I multiplied by 1 plus r.
Okay, don't forget, you only multiply 1 plus R if the cash flow occurring beginning of the year. Okay, for this example, is very particular, end of the period. Okay, so don't only multiply 1 plus R, okay, this factor here, if the cash flow occurring beginning of the year, not end of the year, or the period. Okay, that's what you get there from. I think that's enough with compounding, I guess. And let's go discounting. Discount is what actually more matters more. So discounting. That was compounding, discounting. Now in discounting, is the reverse. Okay, it's the opposite of what you just done there. Okay, this is the determination. This is the determination of the current value. This is the determination of the present value. Okay, of a sum of money. Okay, to be received or paid for. To be received or paid in the future. Okay, that referred to as discounting. Okay, determination of the present value of a sum of money to be received or paid for in the future. For compounding. Okay, simply determine the present value. Okay, called discounting. Next, we do straight through examples. Okay, determine. Okay, the same example you've been doing now. If measure A, okay, deposit value at T3 at the end of T3. T3 means year 3. Okay, T3 was 1331. If I remember, it was 1331. Let me just check. Yes, 1331. If measure A deposit value at the end of T3 was 1331. Okay, how much? How much is the current investment value? What is the current investment value? What was the current investment value was the current investment value. Okay. If R percent is equal to 10%, if R is 10%, if R is 10%. Yeah, simple as that. Therefore, the value of this investment at the end of year 3, okay, is equal to 13.1. Okay, we want to determine what's the current investment value. Don't forget 13.1 is the value 3 years from now. Okay, 3 years from now. But what's the value of this cash? The value of this investment today. Okay, therefore we need to discount. Therefore, future value. Okay, this is given as present value 1 plus R to the power of n. We want to get the present value this time around. Therefore, present value be equal to future value divided by 1 plus R the power of n. Okay, therefore, we got present value. Future value is 13.1, which is the value in 3 years from now. The return we earned is 10% to the power of 3. Therefore, what's the current value, therefore, of this 13.1? How much, Brian?
1,000.
1,000, okay, 1,000, okay. Now the current value of that investment as per today's term, okay. Okay, question 2. Question 2. What is the current value? What is it? If Mr. A, okay, makes $1,000 deposit, okay, at the end of every year, at the end of every year, for a period of 3 years, for a period of 3 years, okay, what is the total? What is the total present value of the deposits? Of the deposit is equal to 10%. Okay, so this Mr. A makes a deposit of $1,000 every end of the period for 3 years. So we'll determine what's therefore the current value of this deposit. Okay, this will be equal to, okay, so here you have deposit in year 1, deposit in year 2, deposit in year 3. We want to get the current value as at year 0. Therefore, we discount this 1,000 back to year 0, okay, at 1.1, okay, the power of -1. Then another 1,000 here, deposit here, 1.1 power of -2, because 2 years later, 1,000, 1.1 to the power of -3. So there we get 909, get 826.751, I guess, I'm not sure. Let me get. Confirm.
2485.
2485, okay, 2485, okay. Now, look, this is an annuity, so you may want to consider that, hey, if you have 20 of them, okay, are you going to be doing 20 individual calculations? No, okay, this is an annuity. Present value of an annuity is given as annuity, okay, 1 minus 1 plus R, the power of -n, okay, divided by R. But in case the cash flows are occurring at the end of the period, like this example you have here, okay. Therefore, the present value will be equal to annuity 1,000, interest is 10%, therefore 1 minus 1.1 to the power -3, okay, we divide by 0.1 to get how much?
2,487.
And 487, and therefore the present value for the 1,000 deposits that is made every end of the year. Okay. So example 3. Okay. So this is a continuation for example 2. Okay, so continuation from example 2. Okay. What would be the current value? What would be the present value, sum of present value if the deposits are made period beginning. Okay, can you do that? So what would be the sum present value if the investment are made period beginning, not in the period, but now period beginning.
Yes.
Yes, Brian.
I haven't gotten to 287.
You got what?
I'm not even getting anything. I don't know if I'm raising wrongly.
Did you raise the power of negative 3? Okay, this was negative 3 here. Did you raise the power of negative 3 here?
Yes.
If the raising isn't working, you can just do 1.1 raised to the power of -3, and then you do 1 divide by the value you get.
Okay, Brian, what do you get?
I've gotten it now. Thanks.
Great. Okay, so try example 3. Okay, from Sanya 27, 27, that's 6.
27, yeah.
Not 27, not 24, 27. Okay, confirmation.
Yes, I got the same thing.
Okay, fair enough. I think we can do it then, do it together. Okay, so the cash flow that we get is occurring at the beginning of the period. Okay, therefore, the value will be equal to present value will be equal to the annuity 1,000 times 1 minus 1.1, the power of 3, 0.1. But the cash flow are occurring beginning of the period. Therefore, you qualify this formula, okay, by multiplying 1 plus R, 0.1. Okay, and you get 20, so that's 6. I assume 27, that's 6.
Yes.
Okay, you get 27, that's 6, therefore to be the present value if the cash flows were to occur at the beginning of the year. Now let's do example 4. Okay, example 4. If the deposits, okay, add year, they occur end of the year, are for 3 years, but beginning 3 years from now, but beginning 3 years from today, what is the current value, what is the present value, or the present value of the deposits? Okay, can attempt that. So the deposits begin 3 years from now for 3 years. Okay, they're what therefore with some of the present value of those deposits. Okay, so the deposits begin 3 years from now for 3 years. Okay, they're what therefore the present value, some present value of those deposits.
I haven't finished.
Brian, what do you have?
76.65.
76.65. Okay, Sakina?
33.10.
33.10. Sanya?
33.10.
That 310. Elvin, who do you have? And not in class. Nafisa, what do you have?
2055.
2055.
Yeah.
Okay, 2055. This look a bit close. And let's do it together. So the investment, the deposits begin 3 years from now. Therefore, year 3, year 4, year 5. There are 5 of them for 3 years. Okay. There you have 1,000. You have 1,000 here. You have 1,000 here. We discount them up to year 0. 1.1 to the power negative 3 times 1.1 to the power of negative 4 times 1.1 to the power of negative 5. And you get 68, 683, and 620.
621.
Is it one sum total?
2060.
2060. Okay. Close towards, I think Nafisa got, okay. Okay, here is a delay. Okay, I think maybe most time, I think Brian, you considered from year 1 all the way to year 5. No, don't forget it's not that way. How do you get this, Brian, by the way?
I use the formula.
You use the formula for, what was the N?
I did -6 minus -3.
Minus 6 minus -3. Okay. Okay. Anyway, let's do it. Maybe let me hope this is what you've used. You can also use the formula, by the way. You can also use the formula that, hey, the present value of this 1,000 will be equal to 1,000. Okay. Let's assume that this cash flow was received for the entire 5 years. Okay. We're making an assumption. What if this cash flow was received for the entire 5 years? And by the way, you can use the tables. Let me actually show you how to use the tables if you forget the formula, in case you don't want to use the formula. Okay. You can use the tables. So let me get a table here. Give me a second. Use a table here. Okay, question. Try to go for a past paper that has an answer, has the tables. Hey, see what we get in questions. Let me forget this one. I think I've seen one here. Yes. Okay. Okay, so let me show you how to use the tables. So this is a past paper which I've just picked, okay, and it has some tables here, what we call the present value tables, okay. So the first table, okay, this is the first table which appears in this page 5, is in case you're discounting individual cash flow. If you're discounting individual cash flow, okay, you will discount, for example, okay, we are discounting, okay, 1,000, okay. So the factor, okay, for 3 years, 1,000 at the end of year 3 at the rate of. So let me get my pen here. Okay, so you're discounting at 10%, okay, 10% at year 3. So 1, 2, 3. This is the factor for year 3, the factor for year 4, the factor for year 5. Okay, so it was, for example, that we have just done there, 1,000. Please. Where is the yes? Okay. Okay, so therefore the factor 10%. Okay, so 10% year 3. Okay, it was 1,000 times the factor, which is 75.3. The factor for year 4 is 1,000 times 0.683. The factor for year 5 was 1,000 times the factor 0.621. Okay, which I think hope you want to pick them up from the tables here. Okay, you have here these factors. These are the factors here. Okay, so it's possible for you to use the tables when it comes to getting the present value. Okay, it's possible to use the factor to help you the present values. Okay, but don't forget this first table is in case you're discounting every cash flow on its own every year. For example, year 3 on its own, year 4 on its own, and year 5 on its own. If you want to discount annuity, okay, if you want to discount annuity, okay, then you have to use the annuity table. Okay, it's written there, annuity table. So sometimes you may confuse, which I don't know why you can confuse, but sometimes I've seen it still confusing. Don't confuse. Okay, anyway, so don't forget read the table you're using quite correctly. Okay, like this example, we want to discount cash flow. We have said, what if we assume that this 1,000 was to be received for the entire 5 years, then the factor we'll be using is equal to 3.791. Okay, therefore, the factor is 3.791. If the cash flow was to last from year 1 to year 5, then the factor will be 3.791. It will be 1,000, therefore, times 3.791. Okay, let me just write it down actually so that it becomes clearer. It will be times the factor, present value, annuity factor, present value, annuity factor from the tables. Okay, for 5 years, 10%. Okay, that is in case there is 1,000 was received for the entire 5 years. Okay, this is the value for the tables, the one you just seen, 3.791. However, the reality is that we don't get this 1,000 the entire we don't deposit this 1,000 the entire 5 years. There's some 2 years we are not depositing. That is year 1 and year 2. There's nothing here in year 1 and year 2. Okay, now for the first 2 years there's no deposit. Therefore, we subtract it. Okay, present value and it factor for the first 2 years. Okay, 2 years, 10%. Okay, why do you subtract? Because there's no cash flow for the first 2 years. The cash flow is for year 3, year 4, and year 5. So for the first 3 years, you subtract because there's no cash flow then. Therefore, the present value will go to 1,000 times, okay, the factor was 3.791. That is for 5 years, 10%. For 2 years, 10%, the factor will be equal to, from the tables, let me go back to the tables. The factor 2 years, 10%, it's here, 1.736. Therefore, minus 1.736, minus 1.736, 1.736. And you get how much?
$20.55.
20.55. Okay, more or less the quote you just obtained there, 20.55. Okay, so you can either discount at individual cash flow, but this is going to be out of work for sure in case we have many years. Okay, so maybe the best thing to use would have been to use this formula. Okay, to be easy. But in case you don't want to use a table, then you can use the formula. Okay, you can use the formula which remains as it was. Okay, it'll be equal to 1,000 times 1.1 minus 1.1 power of -5 out of 0.1 minus 1 minus 1.1 to the power of -2, 0.1, and you get the same answer. Okay, you get the same answer. Whether you want to use the tables,
How come we're getting different answers? Like over here we're getting 2055 and the above one we're getting 2060.
I don't, because it could be most likely because of issue of rounding off. Okay, they could mostly because there's an issue of rounding off. That's again we made it. I get different answers.
Okay.
Sir,
Yeah.
on the first working you did,
Yes.
in year 3, it's 751.
Oh, this is 751.
Yeah.
Actually, you get the same answer actually. So you get actually get the same answer. So you get 2055. Okay, 2055. Yes. Okay. So there's no difference. Okay, in case definitely in case you have to use the formula, then you're going to get more or less the same answer. Okay.
So if we use the formula, I used the same thing and I used -6 instead of -5.
This is -6.
Oh, okay. It's a different. Okay. Never.
Okay.
Sorry.
Okay. And that's why I forget, therefore, the present value of an annuity that is delayed. Okay, we call it delayed annuity. Delayed annuity. Okay. Maybe we can do another example. What example? For example 5. Let's do another example. Example 5. Example 5. If Mr. A was to receive $1,000 per annum to infinity, per annum to infinity. If an asset, let me give you, if an asset was to yield, if an asset was to yield $1,000 per annum, okay, to infinity, what would be the present value of all the receipts and is equal to 10% per annum. Okay. So you want to get this an asset that gives a return of $1,000 to infinity. So it gives 1,000, okay, without a net period. Okay, there's no n. Okay, like in the previous example you were doing. Okay, so if that's a case where we have no end period, okay, we don't have an end period, then what therefore would be the present value of these 1,000 and every year until infinity? Okay, to be equal to the present value of what we call perpetuity or an annuity. Okay, let's call it perpetuity. Okay, we divide by R. Okay, let's get the present value of this cash flow to infinity. Okay, which will be equal to 1,000. We divide by R, 0.1, to get therefore $10,000. And that's the present value of this 1,000 to be earned to infinity. Let's get the present value of cash flow to infinity. Clear? Any question?
What's the logic behind just dividing by R?
It's just a formula because don't forget, there's no, this is a cash flow that is being received to infinity. We don't have an end period. Okay, there's no like in the previous examples we had, for example, year 5, year 6. Okay, so in that example we have an n, but in this example there's no n. Okay, so in case therefore the period goes to infinity, then the sum of the present value of all the cash flow that we call will be equal to be 1 over R. Okay, therefore the factor is simply 1 over R. Okay, and that's therefore we say that for the present value therefore equal to, okay, the return received, okay, is equal to therefore simply 1 over R. Okay, so it's simply a formula that we're going to we pick it up. Okay. Oh, that's clear, Brian. If, by the way, you make you have to make an observation to get the sum of the cash flows, the present value, okay? If, for instance, you are to, okay, maybe from the tables, okay, you don't need to do this, but just make an observation. If you do from year 1 to, if 10%, year 1, year 2, year 3, year 4, year 5, no, let's observe from the table itself. Let me actually share the table, okay? This is the other table that we have, okay? If we were to, if the number of years increase, like for example, to 100 years, not sure they have here 100 years, and these are 15 years, okay? These are 15 years. And just like 10%, okay? Then the years they're increasing. Okay, if the table is a bit extensive, okay, let's say to 100 years, okay, then you observe that the factor here, let me just pick 10. Pick 10 is a bit easier to explain. The factor here are 10 years, okay, 10 years or 10%, okay, 100 years, okay, 10%. If this was 100 years, okay, the factor here will be very close to 10. Okay, the factor here will be almost close to 10. Okay, therefore, as you go to infinity, it approaches 10. Okay, therefore, it is 1 divided by R. Okay, That's the case. Okay. Let me see if we can get a table that has 100 years. Okay, because they're there. So present value tables. Okay, no, these are not. They are until 20 years. Okay, they are until 20 years. So don't need more than this. Okay, these have 50 years. Not so bad. I think we can use them. Let me share my screen. Okay, so this was until 50 years. I hope you can see my screen. So that's for the future value. Okay, on the present value table. Present value table to infinity. So let's say take 10%. Okay, so we can see where 10% is. Unfortunately, I think I can open. Yes, I think that's better. So that I can be able to ink. Let me share. Yeah, there it is. Hope you can see. So 10%, the present value annuity table, present value annuity table, present value annuity table. This is single cash flow. Annuity table is here. 10%, 50 years. Okay, hope you can be able to observe. Okay, this is 10%. Okay, as you move towards infinity, okay, more infinity, the value moves close to 10. Okay, they can't go beyond 10. Okay, so let's move down. Okay, we can see. Okay, so let's move towards down. Okay, they're going to move towards almost close to 10. Okay, which is the 1 plus 1 divided by r. For the factors as you will see. Okay, so as we move close to infinity, then the maximum can go is until 10. It can go beyond 10. Clear, Brian?
Yes, thank you.
Okay, great. So I'm not sure there's anything remaining on how to discount the cash flows. Delayed annuity, you're done. How to discount the cash flow. Okay, having done the concept of discounting and compounding, I guess now we can now apply it now in the method we have been discussing, the NPV, IRR, and the discounted payback. So let's go back and discuss the NPV method, how to get the NPV, because this is now we need now to apply, okay, the discounting concept in the questions. Okay, so let's apply it now. NPV, where is this?
Sir,
Yes.
could you please show me the question number 5, the perpetuity one?
This question for perpetuity, this one. Let me share. So I can see it. This one, you can see it.
Oh, there's something blocking the screen. Okay, yeah, it's fine.
It's okay now?
Yeah.
Okay.
Yeah, thank you.
Okay, let's go to the notes here. We start applying the discounted concepts here. Okay, the discounted cash flow techniques. Okay, as you said, when it comes to the discount cash flow technique, we need to discount the cash flows back to year 0. Okay, and you see that you can use 3 method, the NPV, the IRR, the internal rate of return, and you have the use of the discounted payback period. Okay, so begin the first one, the use of the net present value method, the NPV method. Now, in the NPV method, in the use of the NPV method, it's simply determining what cash flow, okay, what's the present value of cash flows that you'll be receiving over the life of this investment? What's the total amount of cash flow, present value of cash flow you can be receiving from this investment over its life? Okay, therefore it's given us sum present value of cash flow divided by minus the initial investment cost. Okay, What's the excess of the present value of cash flow we get from this investment over the amount we spent in the project? Okay, so if for instance we spent, let's say, the sum of cash flow we get is therefore 13 million, okay, and the initial investment, the amount we spent is 10 million, okay, there was excess, okay, the excess therefore is 3 million, and this excess therefore we call the NPV, the net present value, okay. Simply, the initial investment, okay, was excess of cash flow we are going to be received from this investment over what we spent, okay. We spent the 10 million, we got back 13 million, was excess, therefore positive 3 million. Is a good investment to make? Of course it is. Because you spend 10, you got 13, you got 3 more. Therefore, this therefore is a good investment. Why? It is going to be increasing the wealth of shareholder. Okay. Because the shareholder spent 10 million, they got back 13 million. This is a good investment. Okay. So it implies therefore, if we have a positive NPV, okay, which implies therefore, if we have a positive NPV, then that's therefore is a good investment. It will be increasing the shareholder's wealth, for example, by 3 million. If it is positive 10 million, then the company's value will increase by 10 million if the company was to invest in that particular project. Okay. So that's on the use of NPV. Very straightforward. Okay. So it's given us, okay, some present value cash flow minus initial investment. So it's given us, I just put down, it's given us sum of present value of cash flow from this formula here. Okay, present value of cash flows minus initial cost, minus the initial cost, initial investment cost, therefore the NPV. Okay, don't cover the formula, it doesn't help you at all. Okay, simply the sum of present value of cash flow minus initial investment cost. Okay, as you have mentioned, if the NPV is positive, okay, then we accept this is a good project, okay, because it is going to be increasing wealth of shareholder, okay. As I've told, in case we have a positive 3 million, that means that for in case we accept this project, then the company's value will increase by 3 million, okay. If negative, okay, if the NPV is going to be a negative, okay, what does it mean? It means for the shareholder's value will be decreasing, okay, because if we spend 10 million, okay, we got back 9 million. Is this a good investment? No. Okay, why? Because we are going to spend 10 million, we get back 9 million. Why should we therefore invest in that project? It doesn't make any sense. If the company invests in this project with a negative NPV, then shareholders' value, company's value will decrease by 1 million, for example. Therefore, we reject such a project. Okay. Therefore, if it is going to be zero, we spend 10 million, we got back 10 million. It means therefore you remain where you are. Okay. There's a point of indifference. Okay. It doesn't change your current status. Okay. You remain where you are. You spend 10 million and you got back 10 million. So is it worthwhile? It does. It's not that it's worthwhile. Okay, it's not bad. Okay, neither is this good. Okay, because you just remain where you are at 10 million. Therefore, a point of indifference.
Sir, so just to be clear, NPV is how much you get back from investing.
The excess is the excess, not how much you get back. The excess.
The excess of
how much money do you spend? 10 million. Okay. How much cash do you get back? 9 million. There was excess of the amount you get back over what you spent.
Oh, okay.
Because therefore the NPV. Okay. Don't forget, we're going to have where you need to pay more concentration on. Okay. To get an NPV is very easy. Okay, just discount the cash flow. There you've just done there in the introduction towards time value of money. Okay, discount cash flows minus 10 million, for example. Okay, so the NPV is going to be very easy. But now to get the cash flow, the one you want to discount, okay, that's when you're going to have most of the problem. Okay, how to get the cash flow for each of the year over the life of the project, over the life of the investment, which that means therefore you need to spend more time when it comes to getting the cash flows. For example, okay, this is just an example. Don't copy, okay? If you want, you can copy, but don't cram it in short, okay? So if, for example, you have an investment, okay? If, for example, you have an investment that is going to have a life of 5 years, a life of 4 years, okay? We quantify the amount of cash inflow that we'll be receiving, okay? Minus cash outflow, and we get, therefore, the net cash flow for the period, okay? For example, what the cash inflow is from sale, okay? All the cash outflow, the cost you incur in earning those sales, okay? You pay tax to the government, therefore, less the tax you pay to the government, okay? Is there any benefit you see from the tax allowances? Yes, it's benefit. Therefore, add the benefit. Did you spend some money towards working capital? Yes, you spend money. Therefore, less working capital. Therefore, you get the net cash flow for the period. You discount back to year 0 and you get the present value. Then you add the individual cash flow all the way from the 5th year to year 0. Get the sum present value of those cash flows. Then you minus the initial cost, which you have here, and you get the NPV. So the concern will be more towards to get the cash flow. This is the concern will be, okay, how therefore do we get the cash flows, okay, from year 1 all the way to the 5th year, okay. Once you have the cash flows, then you've done the question more or less, okay. And as I mentioned, don't forget that most of the marks the exam will be giving you will be more towards here, okay, getting the cash flows, okay. Here they'll be only like 2 or 2, maybe 2 marks, but here they can be as much as 10 marks, okay. So you pay more concentration when it comes to quantifying the cash flow for each of the year, okay. Which I think you've done already, okay. So get to know what are the cash inflow, what are the cash outflow. Do you pay wages? Yes, quantify. Do you pay for raw material? Yeah, you quantify it. Do you pay for fixed cost? Yes, you quantify it. Money into the business in terms of cash inflows, in terms of scrap value. Okay, so to quantify all the cash inflow and all the cash outflows for a given time period. Clear? Okay, so don't cram it, but most of the time the format will be as that, as what we have as this layout here. Okay, that's what the format will be most of the time. Okay, so cash inflow minus cash outflow, we get the net cash flow. Discount back here 0, we get the present value. We minus initial cost, and we get the NPV of the projects. Okay. So take a minute to go through it in case you want to. Okay, go through it. Then we discuss.
Sir, a question. What is tax benefit on current assets?
No, okay, sorry, this is not current asset. This is tax benefit on capital allowances. Okay, you've done F6, taxation tax.
No.
Not yet. Okay, so generally, government sometimes can give allowances where they tell you that to encourage investment, okay, to encourage people to invest. Okay, they can tell you that in case you invest in a capital asset, you buy a machine, okay, then a portion of what you spent, okay, you can use it to offset against your profits. Okay, for example, if you spent 1 million, okay, if you spent 1 million, then 25% per year of what you spent, which is in this case 250,000, you can use this money to offset against your profit to pay less tax. Okay, so in that year, if you made a profit of 500,000, okay, let's say for example, if you have made a profit of 500,000, the tax you're meant to have paid was equal to, let's say, 150,000. Okay, however, since you have allowance of 250, the amount of tax you're meant to pay will be equal to 500,000, the profit you had made minus the allowance given to you by the government, 250,000, to give therefore a balance of 50,000. Therefore, you pay tax based on the balance here. Okay, time therefore 30%. Okay, to give us I think 25,000. Yes, to give us 25,000. Therefore, since now here there's allowance given to you, okay, the tax you meant to pay is 25,000. If there's no allowance, you meant to pay a tax of 150,000. Therefore, you make a saving, okay, of how much? 25,000 per year, which is 150,000. The tax here minus the tax after. Okay. Therefore, this is a benefit. We're calling benefit on capital allowances, a cash inflow for the next 4 or 5 years. Clear?
Okay. Yeah.
Okay. There's no more once we discuss this question. Okay, once we go through this question, we shall apply that concept. So okay, go through it, then we discuss together. Okay, so we need to get determine how viable this project is, okay, if we are to use the NPV method, okay. So of course, begin by quantifying the cash inflows. So in this, there are 5 years. We can have year 1, year 2, year 3, year 4, and year 5. So first, I quantify the cash we earned. So from sales, okay, cash we earned is 1.4 million. So them in thousands of dollar. 1.4, 1.3, 1500, 1600, and 1900. That is cash inflow from sale. There was some cost incurred in only this sale. The cost that was incurred every year was 0.7 million. Therefore, 0.7 million every year. Okay, what remains therefore is 700. Here is equal to 600. This is 800. Here you have 900, and here you have 1200. When you pay tax, because you pay tax on the earnings, the tax you pay is a rate of that percent. Okay, therefore you pay 210 cash outflow because you're paying. You pay 180, you pay 240, you pay 270, and you pay 360 because of the profit that you did. Okay. However, you've been told that this is not a tax you're meant to pay because here the government is giving you a chance to you can claim allowances, okay? Because you spend 2.2 million and be told that you can claim 25% reducing balance basis. So let's tell me therefore how much therefore the amount the government will be saving you in terms of tax, okay? So we can that gets therefore to be our next working. We get the capital allowances, okay? Capital allowances. Okay, year 1, year 2, year 3, year 4. Okay, the amount you spent was 2.2 million. Okay, you spent 2.2 million. Then you can claim 25% of it. Therefore, as per year 1, you claim 550. Year 2, you claim what is remaining. Okay, and what is remaining is 1650. You claim 25% of that. They give us 12,500, I guess. Confirm year 2, the amount of allowance that you can claim. Confirm those figures.
It's correct.
Okay, year 3, the balance brought forward is 1,237,500 times 25%. Give us how much? 3.
309,375.
3.
309,375.
375. They are 5 years. Okay, therefore the balance is 9 something
928, 125.
125 times 25%. Okay, to give us
232,031.
The 3-1. Okay. Now year 5 is the final year. So year 5 is the final year. So in the final year, what will happen is that you claim what we'll call the balance. Okay, we'll call the balancing allowance. Okay, it's called the balancing allowance. So by the end of year 5, the total amount you ought to have claimed by the end of year 5, the total amount that we ought to have claimed, okay, is equal to the cost of the assets, the 2.2 million, minus anything you got from this disposal. Okay, by the end of year 5, they'll have zero value get from its disposal. Then the total amount you have spent is 2.2 million. Therefore, we need to get that back. Okay, therefore, in year 5, you claim the balance. There was a balance. Year 1, you claimed 550 for 12, 09 to that 2, and you meant to have claimed 2.2 million. Therefore, the balance is claimed in year 5. And how much is it? 6.
696,094.
696,094 that's the amount you claim in year 5, which is a balance. Okay, we call the balancing allowance. Okay, now this is allowance. Okay, there's no any cash that you have as per se. There's no, this is not a cash inflow or cash outflow. Okay, what is S is a saving. Okay, the S is a saving, what we call the tax saving. Okay? The tax saving. So let me explain the saving by an example. Okay, so if, for example, in year 1 we made a profit of 700. Okay, we made a profit of 700. This is a profit you made. The cost, the sales minus cost, 700. Therefore, the tax you're meant to have paid is 210, which you have it here. However, the actual tax you're meant to pay in year 1 is how much? Okay, the actual tax you're meant to pay in year 1, okay, is equal to 700 minus the allowance given to you, 550. Therefore, the profit that is tax chargeable is therefore 150,000. Okay, the tax you're meant to have paid is therefore 150,000. Okay, times 30% to give you 45,000. Okay, the actual tax you're meant to pay in year 1 is 45,000. If there was no allowance, the tax you're meant to have paid is 210,000, which you have it here. Therefore, because of this allowance given to you, you made a saving of how much? The saving will be equal to, the saving will be equal to, okay, 210,000 minus 45,000 to give us 155,000, I guess. 165. I think 165. 165.
Yeah.
Okay, 165. Therefore, you save 165,000. This is the amount you have meant to have paid, but you will be paid. Therefore, this is a saving to you. Okay, it's a cash inflow to you. Okay, a saving of 165,000, which is actually equivalent to, okay, you can do this and as equal to the allowance given to you, which was 550,000 times the tax rate, okay, which was 30%. And you get how much?
165.
165. Okay. Therefore, this is the allowance times the tax rate. Allowance times the tax rate. Therefore, in year 1, it will be equal to 165,000. In year 2, the same process. Okay, times 30%. Okay, all the years times 30%. Therefore, the savings. You get how much in year 1, year 2? One.
$123,600.
Year 3.
$92,813.
Year 4.
$69,609.
Year 5. 2.
$208,828.
828. Okay, then will come the tax saving. Therefore, here we can have tax savings. Okay.
Sir, I'm getting a different answer for year 2.
Yes, year
Just
2.
want to confirm. Yeah.
Year 2, you're getting what?
123,750.
123,750. Yeah, that looks to be a bit correct.
That's right.
Okay, 123,750. 123,750. Okay, great. Therefore, they are tax saving. These are tax saving. These are cash inflows because you didn't make savings on tax, which you could have paid. Okay, the saving was 165. Okay, for year 1. Year 2, it's 124. That is to the nearest of 1,000. 80. Year 3 is 93. Tax saving is a cash inflow. There is a positive. Then you have 70. Year 4, and you have 209. 209. There's no scrap value. There's no working capital. And that is it. That is it. Okay. Therefore, this is covered for cash flow.
So what
Okay.
about depreciation?
Sorry?
Depreciation.
There's no, don't forget, depreciation is an irrelevant, okay, cost here. Why? Because there's no any actual cash movement, isn't it?
Yeah.
In the depreciation, in the depreciation, there's no any cash movement. Therefore, we ignore it altogether, isn't it?
Yeah.
Therefore, ignore it. Okay. Therefore, year 1 was a net cash. 700 minus 210 plus 165. 6. Six with 5. Okay. Yeah. So do that for year 1, year 2, year 3, year 4, year 5. Get the cash flows. So get for the entire, get for year 2, for year 3, for year 4, for year 5. Then give me the answer. Then we shall discount them back to year 0.
For year 2, it's 545.
545, year 3.
653.
653, year 4.
700.
700, year 5.
1049.
1049, okay. Confirm those values.
Yes.
Okay, great. Then we discount the back to year 0. These are cash flows now. We discount the back to year 0 and the company cost of capital, which you've been told in a question to be equal to 15%. Okay, we discount therefore at 15%. Present value interest factor, 15%. I think, let me share the tables with you, okay, on the group, okay, for the sake of discounting. I hope you know how to use the tables, okay. Let me share these tables with you. So give me a second, I share the table. Now, what's our group? What's the name of the group? I have so many groups for this, you know, which is which. Okay, I think I've seen it. Okay. File. Okay, so here's a question there, okay, or past paper question that has the tables there, so you can use it, okay, to get those factors. So the cash flow, okay, times the factor from the table, okay, 0 point something, okay, all of them. Then we get the present value, okay, the mean of this. So present value is the cash flow to the factor for each of those 5 years. Okay. Okay. Then you get the sum, then minus initial cost, and you get the NPV. So maybe just show you how to use the tables. I know you know, but just to ensure that I don't assume. Okay. So the tables that I want to use is the table I want to use. You share. Okay, so don't forget, so you need to know which table you want to use. Not this second table. We want to discount individual cash flow, so not this one. Okay, therefore we use the first table. Okay, you have it here. We won't discount at 15%. 15%, here it is. Okay, so for year 1 it's 887. Okay, so year 1 to year 5. So I have them here. Year 1 to year 5. These are the factors. Okay. I think you have the tables with you. So 87, for example, year 1, 0.87. So year 1 cash flow times 0.870. Okay. Year 2, 0. 02 0.756 756 0.756 all the until the last year. So we apply the cash flow, times the factor, we get the present value. Once you have that, we get the sum of present values. Year 1 all the way to year 5, get the sum. You can ignore the decimal, so you just use them in thousands. So ignore the decimal in case there be a decimal. Another, you do to the nearest of 1,000. Okay, do to the nearest of 1,000. Sum of present value, what do you get? Sanya, what do you have?
I got 57.
Yes, okay. Year one. Give me the present value for
Yeah,
year
yeah,
one.
57.
57.
Yeah.
How? Because this is 685 times 0.87.
Five 70.
Of
Sorry. Sakina, go ahead.
569.85.
569. Okay, you know, to the nearest you get
70.
570. Okay, so to the nearest you get 570. Year two.
412.
For 12. Year three.
430.
430. Year four.
400.
400. Year five.
521.
521. Sum. So get NPV is sum of present value of cash flows, the one you've just determined, minus initial cost. So the sum of these present values here, I'm assuming that they are correct, all of them.
Yeah, they're correct.
Okay, great. So what do you get?
2333.
23, that's 3. That way.
Yes.
Okay, 23, that's 3. Therefore, the NPV, therefore, is a difference, which is therefore 103. 103,000. Okay, to be therefore the NPV. Should we invest in this project? Yes. Okay, because it is a positive NPV. That the amount you're going to be getting is 103 more than what you spent. Okay, the project is acceptable. The project is thus acceptable. The project is financially acceptable. Okay, acceptable since it has a positive NPV. Since it has a positive NPV. PV you can mention of 133,000. Question? Okay, as you can see, don't forget, there will be more marks when it comes to getting the cash flows, because that's where you spend more time, okay, when it comes to the calculation. To get NPV, only 2 marks you'll be getting, okay. Question?
Sir, I have a question.
Sure.
Like if you're doing this calculation in the exam and let's say we get the present value wrong, but our further calculations are correct. Like if our total present value is wrong, but to get the net present value, the formula is correct and what you are doing is correct, just with different values. Is that going to be correct or completely wrong?
Okay, if, for example, maybe you get, so what is going to happen in case you use the wrong, maybe discount, you want to use the wrong discounting date, then of course you get it, the NPV will be wrong. Okay, that is for sure. So the marks for the NPV you don't get, but all the other marks you get, the advice you'll be getting, even though the advice was based on the correct value or the wrong value.
Sorry, I couldn't hear you. So could you please repeat? Sorry.
So what is going to happen is that you'll be getting, so the marks for the NPV will be wrong. You want to get a mark for the NPV, but the mark for all the other values will be getting them. Okay, the marks for, maybe if the marks for formula, you get a mark. If there's a marks for the advice, you'll get it also. But the marks for the NPV, you'll be losing it. Okay.
Okay, thank you.
Yeah, so you only lose a mark for the NPV, but all the other marks, if you did the right thing, you get them. Okay. Okay, great. Then we can break. We meet at 2:15. Okay, then see you at 2:15. Okay. Okay, don't forget. Okay, don't forget to sign in case you're not signed.